a voice from the banking industry. Remember, lots happening with the currency, with the expectations of a CRR cut growing stronger. N. Sheshadri, Executive Director of Bank of India, joins us right now on the show to talk about all that and more. Mr. Sheshadri, thanks so much for joining in. Firstly, a word on the currency. It's hit a new 7-week low, 50.65 of the rupee vis-a-vis the dollar. To your mind, what's the current trend like, and do you expect further depreciation in the rupee vis-a-vis the dollar?
No, rupee dollar should trade between the present level and 50, 90, 95, 51. I think 51 will be a very crucial mark. There is definitely inherent weakness which is getting reflected in the rupee depreciating. But I wouldn't see, in fact, rupee really depreciating beyond 51 in the near term.
Okay. The other topical point before we get into how the bank is doing per se as well, Mr. Sheshadri, is what do you expect the activity from the RBI to be a day before the budget? The voices for a CRR cut are almost certain there. I mean, most people are saying that it's a certainty that the CRR will be cut maybe 25 to maybe 50 basis points. What's your own sense? One, with the CRR, and two, with the other policy rates.
Yeah. Now, there is definitely a liquidity pressure, and definitely there is a hardening of the interest rate. RBI would like to infuse liquidity, and I think 50 basis points CRR cut is something which is generally expected, and then it might happen. And as far as CRR repo rate cut is concerned, I think I would go with 25 basis point cut, because ultimately Reserve Bank of India may have to signal in very clear terms about the reversal of the interest rate. Although signals were available in December, I think there is a need to basically see that reversal in terms of monetary action. So 25 basis point repo cut coupled with 50 basis point CRR cut is what in fact is expected.
What about the concerns on asset quality as well as the basic matrix of performance for the banking sector as a whole and also for Bank of India? How do you see the first quarter of the new financial year panning out, and how different would it be?
I think the worst was over when the banks started cleaning up in the last first and second quarter. And third quarter did see some amount of an improvement in the asset quality, and coupled with a good recovery on small value. And we see the trend continuing in the current quarter also. While there are definitely pressures in terms of accounts coming into CDRs, some sort of restructuring, but restructuring is something which is part of the regular banking business. And most of these assets which are coming for restructurings are all viable units who require some extra amount of cash in terms of liquidity. And banks do take into account the viability and then provide them the need-based restructuring. There is not much of a pressure in terms of these restructuring accounts turning into NPA. And the small value accounts are responding to the recovery measures that initiated. Overall, asset quality is something which you will see an upward positive trend, in the sense fresh inflows may be lower than the recoveries. And on a quarter-on-quarter basis, you can expect some sort of a moderation in the NPA levels.
Mr. Sheshadri, it's interesting you say that. The reason I'm actually asking this to you is that from the listed space alone, in the last 1 week, we've heard about 2 or 3 proposals for CDR from companies which supposedly were looking very sound but had high debt levels. I'm sure that from the unlisted space, there are numerous other companies which are turning to the CDR route as well. Isn't that a bit troubling? And for Bank of India in particular, what's the kind of exposure that you have had to some of the companies which have probably opted for the CDR route? Say maybe a Hotel Leela or a couple of others which may not even be listed.
The CDR per se itself, in fact, doesn't result in NPA. There is a pressure in terms of the overall provisions, basically because you require additional provision on account of loan coming for restructuring. And in quite a few cases, we do see some sort of a reduction in the interest rate. But what we have seen in most of the cases which comes for CDR of late is, what they require is not a reduction in the interest rate. They do appreciate that, in fact, the bank's costs need to be funded, and they also see going forward the next 2-3 years, interest rates are going to basically go southwards. So they don't really seek much of an interest rate benefit. What they are looking to is some sort of an elongated period where the cash flows need to be conserved, because ultimately the capacity utilization has gone down, and there is pressure in terms of the higher interest rate resulting in lesser liquidity, the financial cost has gone up. So CDR per se should not be linked with NPA. CDRs do happen when there is actually an economic downturn, and you need to basically revisit the terms on which in fact you have sanctioned a project loan or an asset loan. And CDR is definitely a part of the whole revisiting of those parameters.
Mr. Seshadri, allow me to interrupt. We're running short of time, so just want to get some numbers going. Do you have any exposure to Hotel Leela, which is opted for a CDR package?
I may not be able to share with you client-specific information.
Okay, but you do not foresee any or all of these companies which are opting for the CDR route to have any kind of an impact on the bottom line for Bank of India for the JFM quarter or for the next quarter? No substantial impact.
No, we don't expect. No, we don't have much of an impact because ultimately the net present value diminution is getting offset with the interest rate readjustment. I don't expect any diminution in the value.